Many small business owners register an entity structure before they truly understand it. At that stage, it feels like just paperwork. You need something to start operating. But once profit grows, this choice becomes critical. This isn't just paperwork. It's the architecture of your business. The wrong choice now can cost you money, flexibility, and peace of mind later. So in this video, we evaluate every entity through 3 strategic pillars. First, how the business is taxed and which returns you file. Second, whether your personal assets are protected. Third, whether ownership can evolve as you grow. These pillars guide smart decisions. So let's jump into the video. If you run a business alone and haven't formed a separate entity, you're automatically a sole proprietor. There's no legal separation between you and the business. If the business owes money or gets sued, your personal assets are at risk. Taxes are simple for this entity. Profit goes straight to your personal return using Schedule C. Self-employment taxes are calculated on Schedule SE. This structure is easy, fast, and low cost. It's perfect for testing an idea or running a low-risk business. But as profit grows, or contracts involve risk, it can leave you exposed. For businesses with multiple owners or higher-risk operations, a partnership becomes the next logical step. Once you bring in another owner, a partnership becomes the default. Each partner contributes capital, skill, or labor, and shares profits and losses. In a general partnership, liability is shared too. That means each partner can be personally responsible for the debts or mistakes of the other. Some groups choose a limited liability partnership to limit their personal exposure, while keeping the shared ownership model. Taxes are still passed through. The partnership files a Form 1065, and partners get a Schedule K-1 for their share of profits or losses. Partnerships give more flexibility than a sole proprietorship, but they require alignment between partners to avoid disputes. If you want legal protection like a corporation but still keep flexibility, the next step is the LLC. The LLC offers the best of both. It provides a legal shield for your personal assets, and it offers flexible tax options too. An LLC can have 1 or more members. Members can be people, corporations, or even other LLCs. Profits can be allocated based on the operating agreement, giving you full flexibility. By default, single-member LLCs are treated as disregarded entities for tax purposes, and multi-member LLCs are taxed as partnerships. But you can also elect corporate taxation, if that fits your strategy. This structure works well for medium to high-risk service businesses. You get protection without overcomplicating ownership. If you're planning serious growth or outside investment, the next entity type is a C corporation. The C Corp is a separate legal entity designed for growth and scale. It provides strong liability protection for owners. It can raise significant capital, and it allows multiple classes of stock. Governance is more formal in this entity type. You need articles of incorporation and a board of directors. Investors usually prefer this structure. For solo owners or small service businesses, it may be more than you need. But for businesses planning large-scale growth, exits, or public offerings, the C Corp lays the foundation. In a C Corp, the corporation pays corporate income tax on its profits. If profits are distributed as dividends, you pay personal tax again. This is usually called double taxation. If you want corporate protection but prefer pass-through taxation, the S-Corp election is the next step. An S-Corp is not a new entity. It's a tax status that you elect. It keeps the legal protection of a corporation. At the same time, profits and losses pass through to owners. This helps avoid double taxation. But the eligibility rules are strict. An S-Corp can have a maximum of 100 shareholders only. They all must be U.S. individuals, trusts, or estates. Only one class of stock is allowed in this structure. No partnerships, corporations, or foreign owners are allowed here. For profitable service businesses, this is often the sweet spot. It combines liability protection with tax efficiency. If you want a deep dive on how smart S-Corp owners pay themselves, check out our salary versus draw video. Now let's compare the entities side by side. The S-Corp is great for profitable service businesses, but it has strict limits. You can have a maximum of 100 shareholders. They all must be U.S. individuals, trusts, or estates, and only one class of stock is allowed. The C Corp removes these limits. It allows unlimited shareholders. Multiple classes of stock are possible. Foreign investors are allowed. This structure is built for serious growth and capital raising. The LLC sits in the middle. There is no federal limit on members. Profit allocation is flexible, based on the operating agreement. Members can be individuals, corporations, or other LLCs. Partnerships require at least 2 owners. Profit splits are flexible, but liability is shared, which can be risky. The key takeaway is this: your choice today affects how your business is taxed. It affects how profits are split. It affects how you bring in new partners later. Choosing the right structure now saves headaches tomorrow. Keep your goal in mind, and then choose the best entity type for your business. Now, here are some action steps for you. Step 1 is to consult the experts. You should talk to attorneys or CPAs. They can help you choose the right entity for your state and your situation. Step 2 is to apply for your EIN. Most businesses need an employer identification number. You can apply directly on the IRS website. Step 3 is to register your business. Choose your entity before registering, and make sure all licenses and permits are in place. The final step is to file tax elections if needed. Always remember, your structure is the foundation of your revenue engine. So build it on solid ground. Choose one that protects what you've built and let you grow. If you found this video helpful, you'll also be interested in our standard versus itemized deduction video. It gives a clear, step-by-step guide to maximize your deductions. I'll see you in the next one.